In June of this year, South Korea had the best performing stock market in the world, but today it is seeing one of the fastest crashes in modern market history, dropping 34% in just 25 trading days, wiping out 2 trillion off the Seoul market. So the question that every investor is asking, was this a uniquely Korean crash, or is it a preview for what's coming up for Wall Street? Because until this week, Wall Street was still enjoying the boom, the Dow near record levels. Yet could this be peak Dow? Because there are signs that the Korean crash is filtering through, the S&P 500 falling 1.5%, the Dow shedding 1,100 points this week. And not only that, 30-year US bond yields have soared to the highest level since 2008. And in particular, concern over levels of AI investment and profitability has caused AI credit spreads to soar. There's a real sense of a sentiment shift. Now, to understand the Korean crash, we need to acknowledge the boom that preceded it. Korea makes the memory chips that the AI revolution needs, Samsung and SK Hynix. As AI investment exploded, so did demand for memory chips. Samsung's chip division will make more profits in 2026 than it did in the past 40 years combined. But as stock prices soared and people talked up the market, there's a very familiar story of investors using leveraged ETFs to pile into the boom. There was the old fear of missing out, and that pushed stocks parabolic. What started the crash was fairly innocuous: the news that China had begun mass production of its own chip-making tools. But as stocks fell, leveraged ETFs are forced to sell to rebalance. The selling isn't a choice, it's built into the product. And this creates a feedback loop that pushes prices lower. That spectacular boom turned to bust. So what relevance does this have for Wall Street? Well, Korean chips are an important supply chain for the AI boom, so the crash in Seoul hit US chip stocks straight away. The AI boom has both lifted Wall Street, but also provided a large share of US economic growth in recent months. But the boom in the US stock market has been very narrow. Since the 30th of March, roughly 69% of the S&P 500's gains came from just 10 stocks like Nvidia, Google and Amazon. And the boom in share prices has pushed the Shiller S&P CAPE ratio to 39.9, not too far below those historic highs of 1999. And the Korean crash has definitely crystallized uncertainties about the future of AI. The problem is that Wall Street has already priced in very ambitious future revenue growth. But there's also a growing realization that it might be harder to make profit than they hoped. Firstly, cheaper Chinese open source models are taking more and more market share from US firms like OpenAI and Anthropic. Secondly, there's a backlash against building data centers. Thirdly, companies are becoming more careful about spending tokens. Fourthly, whilst Nvidia is making extraordinary profits, there is a circularity behind AI spending, with Nvidia funding the revenues of its own customers who then promise to buy Nvidia's chips. But perhaps the most important change is that until very recently, big tech was enormously profitable and had large cash flows. And it was these cash flows that was funding the investment. But now investment has outstripped cash flows, so it has to be funded by borrowing. And perhaps the biggest warning sign for a potential crash is the amount of debt held off balance sheets. And this matters because it hides the extent of debt-funded investment. And the thing that really matters is that credit spreads of AI firms are rising quite sharply. And this shows the growing awareness of risk, and also the fact that firms will need to pay higher interest to fund investment. And as interest rates rise, it makes all this investment relatively less profitable. Now, another factor is the rise in US bond yields. Post-2008, interest rates were close to zero. Bonds gave a very poor return. Then with quantitative easing, there's a big rise in money supply, and most of this found its way into the stock market. The stock market simply gave a better return than holding bonds. But that now is changing. 30-year US bond yields have reached 5.2%. So for an investor seeking income, the bond market is giving better returns without the risks of equity. Now, on its own, this doesn't mean stocks will crash, but it does mean that shares are relatively less attractive than in the post-2008 share boom. The third warning sign is that whilst the stock market reached record levels, the global economy faces real shocks. The Iran war has disrupted oil supplies, and whilst crude oil prices are perhaps lower than you might expect given all the loss of oil, there are real shortages in the refining of diesel. Now, oil shocks have historically coincided with global recessions, but at the very least, global inflation is expected to rise, and that means interest rates will stay higher than otherwise. But there's another complication because US deficits, US debt, is reaching record peacetime levels. Debt interest payments are going up very sharply, and this shows the amount of US debt maturing in 1 year. It means the government need to keep selling more bonds. So here's the problem. If the Fed raises interest rates, it will slow growth and give the government a fiscal headache. But if they don't raise interest rates, there's a fear that consumer inflation will continue to rise. The Fed don't really want to raise rates, but markets are doing it for them. And this is a big problem for firms borrowing to invest, like a huge capex investment in AI, kind of unprecedented in many ways. Now, if you wanted to present a bull case and explain why the stock market has risen so much, then the first case for defense would be the big rise in corporate profit. US corporate profit has risen both in absolute levels and also as a share of GDP. But that has led to an unbalanced US economy, the labour share income going down quite sharply. The household sector is really very weak. The recent rise in inflation caused a temporary fall in real wages. And if you look at underlying metrics for the economy away from AI, there are warning signs like slow employment growth, weak consumer spending. When employment as a share of a population falls, historically this has coincided with recession. Now, it is worth saying that at least on some metrics, things are not quite 2001. For example, if you look at the current price-to-earning ratio for the tech sector, it is currently 32.9, high, but by no means close to the bubble levels we saw in 2000. But the problem is not current revenues and profitability, it is the future ambitions of AI. With the current planned levels of investment, The Economist notes it would require AI revenue of around $2.5 trillion a year. They give the example that 33% of all firms in OECD countries would need to be spending $100,000 a year on AI. Is that plausible? Now, 2026 has seen exponential growth in AI investment spending, but firms are kind of becoming a bit more careful in spending those expensive tokens. So what is the verdict? Well, there's two ironies. Firstly, the UK FTSE reached record levels this week because it is seen as an anti-tech index. It's dominated by old-style companies away from AI. You can see here the FTSE 100 and European shares have definitely fallen behind the US stock market in the past decade, but at least part of that reflects tech pushing up US stocks. Secondly, the South Korean crash does need to be seen in context. Despite a 34% fall, it is still 40% up in dollar terms on the start of the year. Yet JP Morgan assigned a 35% probability to a scenario where a slowdown in AI spending triggers a global downturn. And remember those ETFs which damaged the South Korean market? Well, ETFs are a growing issue in the US stock market too. So there are very real concerns. AI technology does have real benefits, but it doesn't necessarily mean firms will make as much profit from it as they ambitiously forecast. And beyond AI, there's a sea change in the investing landscape, with a really significant rise in long-term US bond yields. In fact, an interesting question is, how sustainable is US debt? This video explains what may happen next. Thanks for watching. Do subscribe. See you soon.